Welcome to another episode of Healthy, Wealthy, and Wise Retirement Podcast, where certified financial planner Lauren Sherman shares thoughts on having a healthy mind, body, and spirit, an abundance of wealth inside portfolios and out, and lessons learned from clients and mentors over the years.
Thank you for joining me for another Healthy, Wealthy, and Wise Retirement Podcast. As always, I am your host, Lauren Sherman, and after last time, with a much longer episode than I typically record, this one will be a quick-hitting episode about RMDs. Just like a lot of financial lingo in this industry, RMDs can be confusing, so let's start with what they are. RMD stands for Required Minimum Distribution, which starts at your age of 72. You can think of this as our government telling you that you've deferred paying taxes long enough, and now it's time to make a withdrawal so they can collect income tax. They have a formula that is based on your age and the amount of your deferred assets, which determines how much you are required to withdraw. Because remember, this would include retirement accounts such as your 401k, 403b, and similar accounts that typically are moved into an IRA or an individual retirement account once you retire. During your working years, you were able to keep your income lower by deferring the taxes on these accounts rather than paying them at the time of your investment. This works out well for a lot of people as their income tax bracket was often higher during their working years than during their retirement years. And if you heard me mention that RMDs start at age 72, but you remember having to start them earlier, you are correct. The age used to be 70 and a half, but a revision to the bill pushed this requirement back a year and a half to age 72. And perhaps others still are thinking, I'm taking required minimum distributions right now, and I'm not even 70 yet. If this is you, it's likely because you inherited an IRA from someone who passed away, and in that case, you could be taking RMDs each year regardless of how old you are. Before diving into our 9 RMD questions to consider, I'm going to share a quick cautionary tale. The penalty is quite punitive if you miss an RMD or if you remember to take your RMD but don't take the full amount. If an account owner forgets to withdraw an RMD, fails to withdraw the full amount, or just misses the deadline, the amount not withdrawn is taxed at 50%. For example, if your RMD for the year is $30,000 and you only take out $10,000, you pay an additional 50% penalty for the amount that you missed. In this case, the amount missed would be $20,000. So this retiree would have a $10,000 penalty. So if you have not yet completed your RMDs for the year, I would urge you to consider preparing for this earlier in the year going forward, as no one likes to pay late penalties where we are just flushing dollars down the drain. So with that fair warning, let's start our list of 9 RMD questions to consider. Number 1, is your RMD more than what you need for living expenses? Some retirees have most or all of their expenses paid for through other income. Perhaps this includes income from Social Security, a pension, annuity payments, part-time employment, and so on. If this is the case, you really wouldn't need to take money out of your IRAs other than the fact that you are being told by the IRS that it's a requirement. After making your required distribution, instead of leaving it sitting in cash on the sidelines, you should consider where else you could put the funds to good use. There certainly is no rule stating that you have to spend the money, so often the best course of action is simply to reinvest the funds in a taxable account. In this case, you've satisfied your RMD requirement and stayed invested with the remaining funds after taxes were paid. Number 2, if you have other retirement accounts subject to RMDs, do you need to verify that those RMDs will be satisfied? The short answer to this question is yes. You need to look at all of your IRAs and accounts subject to required minimum distributions, and you can take your RMD from each individual account, or you can simply aggregate your withdrawal to just one account. For example, if you have one IRA that requires a $4,000 RMD, a second IRA that requires a $5,000 RMD, and finally a third that requires a $6,000 RMD, that adds up to a total of $15,000, which can be taken from just one account to satisfy your RMD requirements. And remember, RMD stands for required minimum distribution. So this is the minimum you need to withdraw, but you can always take out more if you'd like. One of the tax planning strategies we always look at with clients is whether or not it makes sense to ease into RMDs prior to age 72 and making use of every year leading up to that age. What this might look like in the real world is, let's say we have a couple who both retire at age 62. Often spouses were born in different years and retire in different years, which can make for additional planning opportunities. But in this case, we will keep things simple and assume this couple was born the same year and both retired at age 62. We might have one tax planning window between age 62 and 67 in which the first spouse starts collecting Social Security. We could have a second tax planning window between age 67 to age 70 in which our second spouse starts collecting their Social Security benefits. We have a third planning window between ages 70 and 72 in which required minimum distributions are to begin. Then, of course, we have another tax planning window for age 72 and beyond. In each of these tax planning windows between the couple's retirement age and their RMD age of 72, we may want to start making IRA withdrawals ahead of time to smooth and potentially eliminate altogether some of our tax obligations that are triggered by RMDs. You can see how this quickly becomes pretty complex, and we didn't even muddy the waters with different birth dates or different retirement dates. We also didn't mention how Medicare at age 65 can alter this planning, how we can begin qualified charitable distributions at age 70 and a half, or we also didn't mention changes to tax law such as the Tax Cuts and Jobs Act, which is set to expire after the year 2025. So for us at our firm, it's important to leverage the capabilities of human advisors alongside tax planning tools that help ensure we are coming up with proper analysis and that we don't end up with any unintended consequences along the way. I talked about the technology that we use called Holistaplan in an episode titled 5 Tax Planning Opportunities, so I will link that one in the show notes if you'd like to revisit that episode. Let's move on to number 3. Is the value of your qualified account significantly up or down due to current market conditions? This can be a tough one because most evidence suggests that the market is never really up or down at any given moment, but that it's always priced more or less correctly. With that said, your next year's RMD will be based on the value of your IRA accounts and every other account that requires an RMD for that matter, but that RMD will be based on valuations from market close at year end of the previous year. That probably sounds a little bit confusing, so let's use a simple example to make this more clear. For the year 2023, you can take your RMD at any point during the 2023 calendar year, but it's going to be based on valuations from the end of December of 2022. Some of you may have found this out the hard way. For ease of numbers, let's say you have a $500,000 IRA invested pretty aggressively. The market doesn't cooperate, and by the time we fast forward 11 or so months, the account has dropped to $300,000. If you delayed taking your RMD until late in that year, the IRS still views your account as if it's worth that original $500,000 and uses that amount to figure out your required minimum distribution. Now you are forced to take out a much larger percentage of your total account value. If you have multiple IRAs that you can withdraw from, you might want to satisfy your RMD from an account that is up, or at least not down significantly, which would give the account that has big losses a chance to recover. That is getting into the weeds a bit, but in short, it's important to understand that your RMD is based on the end of the prior year's close and not your current balance. Number 4, is this an account that you have inherited? Often retirees will have to take RMDs on their own accounts and perhaps other accounts that they have inherited. If you inherit an IRA from anyone other than a deceased spouse, then you cannot treat that as your own RMD, and it will have separate rules. Once again, due to legislation changes from the Secure Act, these non-spouse IRAs are required to be spent down to zero within 10 years of the original account owner's death. If they passed away before the year 2020, you could still be grandfathered into the previous rules, but moving forward, we need to spend these accounts down within 10 years. And again, saying the account must be spent down means the taxes are satisfied, but the account can still remain in your name in a taxable account. So I'm not advocating for a spending spree. Number 5, are you eligible for any exceptions? For example, you are still working and contributing to an employer-sponsored account. This is the first year you are subject to an RMD, and so on. There are a couple of exemptions where you may be able to delay your RMD until April 1st, giving you a few extra months. This may be the case if this is your very first RMD that you've taken, so if you've just turned age 72, or if you are still working and meet a few other criteria. This is something to be aware of, but more so this is for your advisor to understand to help avoid or minimize any late penalties if you do not fulfill your RMD requirements by the end of the year. Number 6, do you need to review your tax withholding to ensure that it is still accurate? Once again, this one is probably more for your advisor, but we need to make sure that any predetermined withholding percentages that you've instructed your custodian with are still sufficient to satisfy taxes for your RMDs. For example, you may have instructed your custodian to withhold 15% in total taxes from IRA withdrawals, but if your RMD bumps you into the 22% bracket, you will have to be prepared for this come tax time. Number 7, do you plan to make any Roth conversions during this tax year? If so, you could help pay the tax liability on your Roth conversion with funds from your RMD. Essentially, this would simply be earmarking these dollars for the specific purpose of your Roth conversion. Be mindful that your RMD must be taken before any Roth conversions can occur. Number 8, have you recognized any large amounts of taxable portfolio income during this tax year, which could be capital gains, dividends, interest, and so on? Even smaller taxable income could potentially tip the scales and push you over the limit, which is particularly important when it comes to taxes that have a hard cutoff, and just $1 over can make the difference between being eligible or ineligible for a tax strategy. Or in the case with Medicare income-related monthly adjustment amounts, which is a mouthful, so this is typically referred to by its acronym of IRMA, being just $1 over can be the difference between paying a penalty for having a higher income or avoiding that penalty altogether. Just like with our 7th question to consider, if we have any larger gains that we recognize within our portfolio, we could earmark the RMD to pay the taxes on these gains, particularly if we are unable to offset the gains with losses elsewhere. Number 9, and for our last question to consider when it comes to RMDs, are you currently 70 and a half or older and planning to give to charity this tax year? You might be saying, I thought you said the age limit changed to age 72. While this is true, they did not change the age requirement to do a qualified charitable distribution, also referred to as a QCD. And while I suppose you could say that there is never a bad way to give to charity, if you are age 70 and a half or older, there is likely a better way that you could be giving to charity. A qualified charitable distribution allows you to donate up to $100,000 from your IRA accounts directly to a charity. The charity must be a qualified charity, so they must be officially recognized and in good standing, but they are able to receive the gift in a tax-free manner, so they can put the full donation to good use. And from your standpoint, as the retiree making this gift, your donation can satisfy part or all of your RMD for that year. The entire amount is deductible, so the withdrawal from your IRA does not count towards your adjusted gross income. This can be a big deal for a lot of retirees, as keeping adjusted gross income, or your AGI as it's often referred to, this figure is very important for tax planning, and it can have implications across the board. One I mentioned earlier regarding Medicare IRMA, which affects Medicare Parts B and D. Others could include whether or not you can deduct IRA contributions, whether or not you can contribute to a Roth IRA, and whether or not you stay under the threshold for net investment income tax, which can be another costly tax imposed on those with a higher income. Of course, the list is much longer, but that gives you an idea of just a few of the tax considerations that we plan for. One last thought on this. I mentioned that you can donate up to $100,000 per year through a qualified charitable distribution. For those who are married and file a joint return, if you are feeling extra generous, you can double the amount to $200,000 per year as a couple. But if you are thinking, let's just do this and knock out several years of the RMD requirement all at once, it doesn't work that way, as the RMD is an annual requirement that must be satisfied on a year-by-year basis. That will do it for our 9 RMD questions to consider. If you have any questions of your own or would like to get in touch, you can find my contact information in the show notes, and I would be happy to connect. Find past episodes at healthywealthywiseretirement.com. And as always, I invite you to come back in another 2 weeks where we will have a brand new episode for you.
Thank you so much for listening and supporting this podcast. If you've enjoyed listening, we would love if you took a quick moment to leave an honest review. Of course, we're shooting for 5 stars, but if you have suggestions to improve the show, we would love to hear from you too. Just click on the podcast name, Healthy, Wealthy, and Wise Retirement Podcast, and scroll down to ratings and review. Thanks again for your support, as this helps us reach a wider audience and help even more retirees just like you. This podcast is for entertainment and informational purposes only and is not intended as a specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and co-owner of Integrity Wealth Management, an investment advisor serving retirees in search of their own healthy, wealthy, and wise retirement lifestyle.